Hi, everybody. This is Alan Ellman, the Blue Collar Investor, with BCI podcast number 43, titled Converting a Covered Call Trade to a Collar Trade. Now, frequently, the strike that we sell when we write a covered call ends up deep in the money as the share price moves higher. We're going to show in this podcast a real-life example using Alexion Pharmaceuticals, which trades on the NASDAQ exchange under the ticker symbol ALXN. What happened in this particular case was share price moved up well above the call strike, and there were two considerations. One, to write a protective put to protect the profits. That would then convert the covered call to a collar strategy, versus just closing the entire trade and using the cash to enter a new covered call trade with a different stock. And that's called the mid-contract unwind exit strategy in my books and DVD programs. So let's get started with this podcast by breaking down the anatomy of converting a covered call to a collar trade. Now, a covered call trade has two legs. We're long the stock, which means we bought the stock, and we're short the call. That's where we write the covered call to generate premium. Now, a collar is a covered call trade with the addition of a protective put to protect to the downside. So then, the collar then has three legs. First, we're long the stock. Then we're short the call. Generally, if we're starting out with the collar trade, we would start out with an out-of-the-money call. In the case you're going to hear about in this podcast, we're going to start out with an at-the-money call. But the typical collar, if we're starting from the beginning with the collar trade, would involve selling an out-of-the-money call and buying an out-of-the-money put. So the call strike would be above the current market value, and the put strike would be below the current market value. And that will therefore set up a floor, the put strike, and a ceiling, the call strike, with the collar trade. Now let's turn to a real-life example with ALXN, which on 3/15 was purchased at 135.18. Right after the share purchase, the covered call was sold. The 135 near the money strike, 1 month out, was sold for $5.11. Now, on April 4th, Alexion had moved up to 140.42. So that was $5.42 above the strike that was sold. The cost to close that short call was $6.60. Now, the cost to buy a put, the 135 protective put, was $1.05. So we're going to break down the math on both of these possibilities. So we can close the entire trade by spending $6.60 to buy back the 135 short call, or we could keep the trade and add a protective put for $1.05, thereby converting the covered call trade into a collar trade. So if we were to examine the way the trade was initially structured regarding the return on the option, if we put the information into the multiple tab of the Ellman calculator, we would first feed in the information that the stock was trading at 135.18, and the 135 near the money strike generated $5.11. Calculator will show us that the return on our option, the initial time value return, was 3.7% for the 1 month. Very, very tiny bit of downside protection of 0.1%. So that means we're guaranteed a 3.7% 1 month return as long as share value does not decline from 135.18 to below 135. So that was the initial structuring of the trade. And of course, at the time, on April 4th, Alexion had moved up to over 140, thereby making the maximum return on this trade look pretty good at that point in time. So let's first have a look at the option chain with Alexion trading at 140.42. if we were to buy a protective put at 135, which is close to the price that was paid for the shares initially, thereby preventing a loss on the stock side. Well, the option chain will show an ask price to buy at $1.05. Remember, we sell at the bid, the lower, we buy at the ask, the higher. So $1.05 would be the cost to add the protective put. Now, that means that would represent a 0.8% of the original investment. All right, so it would lower our unrealized return from 3.7% to take away the 0.8%, which would result in a 2.9% 1-month return. And that return is protected by the put strike. Now, we can't make any more money from this trade because of our contract obligation to sell at 135. We cannot make any more money. So the question becomes does it make sense to lower our current unrealized return of 3.7 down to 2.9 to protect against some unusual share depreciation from over 140 to below 135? That is the question. Now let's take a look at an option chain now, which would involve the cost to close that 135 short call. Maybe we just want to close the trade at this point in time. Where would that leave us? Well, if we looked at an option chain at that point in time, the cost to close that 135 short call would be $6.60. We're buying to close. So once again, we look in the ask column. $6.60. Well, that sounds way more pricey than the put option, but there's way more to it than that. And that's because of this $6.60 premium, $5.42 is intrinsic value. That means that if we bought back the short call, our shares were no longer worth 135, the max they could be worth with the contract obligation in place, but now they move up 542 to current market value of 140.42. So that's kind of a credit on the stock side of 542. The remainder is the time value of that call premium, which is $1.18. So that is our actual time value cost to close. If we sold the stock, we wouldn't be selling it at 135 anymore. We'd be selling it at market value. So $1.18 in time value on a cost basis of 135, that represents a 0.9% cost to close. If you recall, the cost of the protective put on our investment was 0.8%. So pretty close. So now it almost looks like a toss-up. Which strategy we're going to turn to? Buying the protective put to lock in the profit, or just closing at that point in time? Well, once again, there's only a difference of 0.1% between the two approaches. However, if we close the call option and got the cash from the sale of the stock, we now have that cash in our hands to start a new covered call trade. And that means we have an opportunity to generate way more than the 0.1% difference between these two exit strategy approaches. And the guideline we use is if we could generate more than 1%, more than the time value cost to close, then it pays to unwind this position mid-contract, also known as the mid-contract unwind exit strategy in the BCI material. So we're looking to see if we can get a return of 1.9% or more to determine whether or not we're going to close this trade in its entirety as opposed to adding a protective put. So let's summarize now. When a strike moves deep in the money, purchasing a protective put will definitely lock in a percentage of the current unrealized profit. The key word here is percentage, because we have to pay for the protective put, and therefore the percent return will go down. Now, as the time value to buy back that short call approaches zero, then the mid-contract unwind exit strategy may be an even better choice. Now, folks, there is a third choice, which I haven't mentioned to this point, but you probably have it figured out, and that is to take no action at all and continue to monitor our position. If the strike is still in the money as expiration is approaching, well, then we can look at perhaps rolling the option if it meets all of our system criteria. In this particular case, I would favor the mid-contract unwind exit strategy if we can generate 1.9% in a new trade. Otherwise, more than likely, I would just continue to monitor the trade. Okay, before we end this podcast, I want to remind everybody that our website has a ton of free resources. If you look at the top black bar of our website, www.thebluecollarinvestor.com, you'll see a link that says free resources, including the Element Calculator, where you can download the Element Calculator, its user guide. There's also a single column put calculator with a user guide and many more free resources. In addition to training videos, we have our beginner's corner tutorials for covered call writing and put selling and a lot more. If you go to our blog page, you could sign up for our free weekly newsletter as well. If you go to the bluecollarinvestor.com store, we have online video and DVD programs, ebooks, hard and soft cover books, calculator spreadsheets, trade planners, and online mentoring. So there's a lot of resources available to help us master these option selling strategies. I want to thank everybody for tuning into this podcast, which is our 43rd converting a covered call trade to a collar trade. Ladies and gentlemen, I hope you enjoyed this podcast, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.